Welcome, everyone. Thanks for taking the time to join us today. We're excited to have you, and what we want to do is spend some time sharing with you some thoughts around wealth planning, financial planning, and strategies that we're seeing and implementing with clients in this current environment that we find ourselves in. My name is Brad Kelly. I'm the principal in charge of Eide Bailly Financial Services. And I'm joining you today from our Tulsa, Oklahoma office. Joining me today is Kenny Dupree. He is an associate advisor with our firm and is joining us from the Minneapolis location. So, what I thought I would do before we get into really the meat of the conversation today is to spend a little bit of time talking about just what's going on the marketplace right now, and the landscape, the environment, or sometimes I refer to it as noise. And every morning when you wake up and turn on the news, here's probably a number of the things that you're hearing or seeing as you prepare for the day, or throughout the day as you listen into current events and what's going on. And I do call and refer to it as noise, but it is noise that we have to pay attention to and understand what some of these things might mean in the short term, and having then some long-term perspective on some of these things as well. So you can see a number of words here on the screen, and certainly we're right in the middle of things like the labor shortage that is happening right now. There really is an issue across a number of industries. And it's interesting, as we went through COVID and the pandemic, and the economy shut down and people worked from home, I think that a number of people really during that time determined whether or not they wanted to continue working. I think we had people that moved into maybe an early retirement, or we had households that had dual incomes, and decision was made that one person would continue working and one maybe not. Just a number of things that I think have contributed to this labor shortage that we find ourselves in. And in the midst of that, you can see the supply chain topic as well. You're getting a bit of this crunch of having shortage in the labor force. We're having unprecedented demand for goods and services. I mean, if you look at the demand for goods and services now compared to before the pandemic, it's substantially higher. And so there's probably a number of reasons for that. I think it's been a shift to working from home in this new world we find ourselves in. I think that there is so much liquidity in the marketplace right now. People have cash in their pockets, that has increased demand also. So we find this heightened demand. We find that as manufacturers shut down during the pandemic and reopening, trying to get goods and services into the marketplace, with the challenges there, we find just the combination of these things really creating some friction, which ultimately leads to that word inflation that you see on the screen. You're probably hearing a lot about that. It's something that we're watching quite closely here at our firm, and trying to determine, some of the increase in cost or in goods. Is that just a transition into the economy going from being shut down to reopening? Transitionary inflation is the term you're probably hearing. Or is there something that's more longer term here, and something that we need to be paying attention to? One of the things that we watch here is the 10-year Treasury, which is a good indicator of where rates are going and maybe suspected inflation as well. And if you do follow that, you probably have seen since, probably 3-4 weeks ago, 5 weeks ago, we saw the 10-year Treasury spike and actually get into the 1.65-ish range. And so something we were watching to see if that was going to continue as we headed toward the end of the year. But with corporate earnings announcements that have been taking place over the last few weeks, we're actually seeing the 10-year kind of come back down a little bit into the 1.5. So again, that's a good indicator that we watch, that gives us some maybe insight where the market feels we're going from a rate and inflationary standpoint. But in addition to that, there are other things going on as well we're paying attention to. Certainly the combination of the infrastructure bill that's going on in Washington, and Washington as a whole. Just the things that are happening there seem to change from day to day. How much, if the infrastructure bill is passed, to what extent will it be? How big will it be? How will it be paid for? There's a lot of debate and discussion going on right now that we're paying close attention to. And we'll see how that plays out as we go forward. In addition to that, we have world actors as well. So we watch what other countries are doing and as it relates to economic decisions and other things. And what does that mean from a global perspective? I'll end this with just two words that you see: cryptocurrency and blockchain. Those are what I would say are disruptors right now that are coming into the marketplace. And we have clients asking us all the time, should I have crypto in my portfolio? How should it be positioned in my investment portfolio? How should I look at it from an asset class standpoint? Should it be a hedge against inflation? Is it something else? How do I place that and think about that? We know that cryptocurrency is here to stay, but it still, I think, remains yet to be seen how all of that kind of settles in and what it looks like as we go forward. So a lot of things happening, a lot of noise, if you will. But if we really look at it from the perspective of what does that mean short term, what does it mean long term, this graph actually goes back over the last 50 years. And I think what's interesting is if you look at events going on in the marketplace over that period of time, we always have had noise or things going on at any point in time, trying to really decipher what does that mean? How does that impact my financial plan, my wealth plan, and how I organize my wealth, and how should I think about these things? But if you think about it from a long-term perspective, as all of these things have happened throughout time, this green line represents the US stock market, and you can see the ebbs and flows of the market in the short term, but more importantly, you see the long-term growth of the market and how that's performed. And so things that we're hearing about inflation, we had that back in the early 80s. We've had oil prices, we've had events that have taken place in the past that kind of emulate what we're hearing today, and we can see how the markets behaved in those periods of time. This is interesting. I look back at a Business Week article. I don't know the details of the article, but the title itself, "The Death of Equities," would make me believe that was not favorable toward owning U.S. stocks at that point in time. But in spite of that, look what the market did from that point forward. One of the things that we really look at is when we have these correction events. You can see the S&P 500 down, in this case, 43%. We look at in 1987 when the Dow dropped 23%, Black Monday as it's referred to. One thing that we watch is how long does it take to actually get back to where you were after these events take place? A lot of times it's months, sometimes it's years, but it's not really an extended period of time to get back to where you were, unless I fast forward to 2000 to 2010. And this is really only going back 20 years ago. And I think this is something we're talking to clients a lot about right now, is to really understand that there are periods of time when the market does not continue to just go up, up, and up. And so 2000 to 2010 is what's called the lost decade. And what triggered that was the dot-com crash back in 2000. And then we had the 9/11 terrorist attacks shortly thereafter, had some growth coming out of that. And then we had the financial crisis or subprime mortgage crisis that I think a lot of us remember not so long ago, and the markets during that time. But what's interesting, if you would have invested in the S&P 500 in S&P 500 fund in 2000, and you actually held that fund all the way through to 2010, you actually earned a 0% rate of return. It is called the lost decade. Now, from about 2010 forward, if you have the S&P 500 fund, you did extremely well. But it is interesting to look at that and to really understand there are periods of time when the U.S. market is maybe not in favor, In fact, that period of time, international stocks were a great place to get return. And in the US, it was more small cap stocks and value stocks was where return came from. So these are things that are good to be mindful of and to understand how markets behave to short-term events, and then bring that back into your financial plan to really understand the long-term impact from a planning perspective. Coming out of that, what's really interesting, this is what's called the Delbar study. This is something that is in our industry, it comes out every year. In this case, this is looking at from 2001 to 2020, and it's showing the annualized average rate of return of the S&P 500 over that 20-year period was 7.5%. So if you think about, you had 10 years of no growth, and then you had 10 years of pretty significant growth. The average of that over a 20-year period was 7.5%. The bond market over that same period of time provided a 4.8% rate of return. That's what the market provided in that space. This study actually looks at the investor behavior over that period of time, and looks at the inflows and outflows of dollars into the equity and fixed income markets, and actually calculates what was the average investor rate of return, and more retail investor, I'm not talking institutional investor, retail investor, over that period of time. You can see the market provided a 7.5% return. The average investor received a 5.9. We'll round up and say a 6% rate of return over that period of time. Fixed income, much bigger variance between what the market provided, and again, less than 1% that the average bond investor received over that period of time. Why is that? I think that the big reason for that is that individuals, in the absence of a wealth plan and a financial plan, and having long-term goals and objectives and a sound approach to planning, tend to make decisions in the short term rather than thinking about it from a long-term perspective. Every year when this study comes out, this is what we see. Same results. They vary a little bit, but pretty much in line from year to year. So I'm kind of using that to really set up the rest of our conversation. Now, we've been talking about events and noise, if you will, that has been common throughout the last 50 years. There are some things that are going on that are unique right now to where we're at today. One of the things right now is just, where is wealth right now from a demographic standpoint? This actually was in the Wall Street Journal back in July of this year. And this talked about how Americans over the age of 70 have a combined net worth right now of $35 trillion. And if you think about the wealth that demographic holds and the transition of wealth that's going to be happening now over the next several years, the article went on to just look at, there's going to be about $70 trillion passed from one generation to the next between 2018, starting in 2018, out to 2042. And this graph down here actually shows, it breaks that time period down into segments, showing when the expected transfer based on life expectancy tables and so on, when that wealth transfer will be taking place. And you can see from 2023 to 27, we start seeing that transition happening. As we get out to 2038, 2042, you can see significant wealth transfer taking place. I share this with you to just, the thought would be certainly Washington is well aware of this. And as you hear the noise coming out of Washington about tax reform and what to do with exemption, and as wealth transfer is starting to take place, we are kind of into some unprecedented times with regard to the transfer of wealth. And you know that Washington's paying close attention to this and really looking at, I think, reform as it comes out on a going forward basis. This will certainly be in mind. The other thing that's somewhat unprecedented right now is the liquidity that's in the market. If we go back to when we started back in 2020, when COVID first started and we had a steep decline in the market, the Fed did something that that has never done before, and that was to inject liquidity into the bond market, which is really what helped propel the stock market forward at that point in time. And so the Fed doing that injected liquidity into the market. Of course, the government injected liquidity into the market as well for a variety of reasons during that period of time. And so as a result of that, I'm going to go back to what we talked about earlier, unprecedented demand. And there is so much liquidity, and the demand is there that's kind of driving that. Liquidity is driving that. But you're seeing right now $2.5 trillion of cash sitting on the sidelines. And so that is something I think we feel in the stock market. If we do see a little bit of a pullback right now, we typically like to see 10% corrections in the market, maybe 2 of those in any given year. We're just not seeing that right now. And I think part of it is anytime we get any kind of correction, we see cash coming back into the market and kind of helping propel that going forward. Private equity, we are seeing unprecedented acquisition and transition activity happening right now with small business owners. And right now, private equity is sitting on $700 billion of cash looking to deploy into investments out in the marketplace. So something to be very mindful of as we go forward. In the midst of all of that, we're looking at other surveys that just point out what are retirees thinking about right now, people as they head into retirement, themes that you probably would suspect: healthcare costs and where are healthcare costs going. If I retire early, I have a gap between when I retire to when I qualify for Medicare. How do I handle that? What are my strategies for that? The rising cost of living, inflation, we talked about that. I think when you look at low interest rates right now, it's hard to find yield out there, but if prices are going up, I've got some friction in my financial plan and cash flow planning, and how do I deal with that? Any significant downturns in the market, how does that affect my retirement plan? And then we're seeing now, individuals looking for more guidance as they go forward. I would say objective guidance. So with that, in the absence of having a financial plan, what are some of the pitfalls that clients or individuals have in trying to reach their long-term goals? And the first one is just this. I think it was Zig Ziglar that coined the phrase, people don't plan to fail, they fail to plan. I could be wrong on that, but I know that that phrase has been around for a while. And just the failure to having a plan is important, to have a plan so that you can identify what your goals are, so you can set a strategy then to reach those goals. Another pitfall is really lack of communication and trust. Who do I, as an individual, look to help me, to guide me through and navigate through the short-term noise with a long-term perspective? Are there practitioners out there that are not selling products or services but can provide fiduciary objective advice? Inadequate preparation. You don't just wake up one day and decide, I think I'll retire today. You need to start planning for that well before the retirement date. I find that people who really start kind of entering into their 50s, early 50s, is really a good time to really start honing in on retirement date and cash flow needs, and where will my cash flow needs come from. As individuals move into their 60s, now it's really, hopefully I have that put together, and now I'm starting to think about wealth transfer and transition and positioning my assets so that I can maintain my lifestyle, but also pass to the next generation in the most efficient way. And then overlooked essentials. There are so much detail in planning, understanding how to own assets. Should I own them personally, in a trust? My beneficiaries. There are just a number of aspects within a plan that need to be accounted for. So with regard to planning, and before I turn this over to Kenny, what should a financial plan look like? What should it address besides tax planning, which of course is the heart of what we do here at Eide Bailly? But in addition to that, it should contemplate these 4 things. my cash flow needs. That's first priority, is understanding at points in time, what are my cash flow needs and where will cash come from to meet those needs? And over the long term, will I have sustainable cash flow given a set of assumptions? The second part is my investment portfolio, understanding how should my portfolio be positioned as I work my way through the phases of my plan. It is interesting, the day you retire, you don't need all of your investment accounts. It's not a magical date where you go from an aggressive strategy to a conservative strategy. It needs to be contemplated and adjusted over time. The other part of it is just the risk to my plan from an insurance standpoint. If I have a long-term care event or I have premature death take place, is there enough liquidity for the beneficiaries to move forward? And then ultimately, what does the transition of my wealth look like from an estate planning perspective? All of these things need to work together. They cannot be looked at individually in a silo. They have to be looked at holistically, and knowing if I make a change in one area, how does it impact the other areas within my plan? So the last thing before I turn it over to Kenny, we did talk a little bit about the economy and the markets. We're going to do more of that on Monday, November 22nd. We're going to have Jeffrey Kleintop from Charles Schwab join us. He joined us last year shortly after the elections, and we were fortunate to have him and get to ask him questions. And he presented information to us, actually called some things that ended up actually happening as we headed into early part of this year. And so Jeffrey Kleintop is the Chief Global Investment Strategist at Charles Schwab. You watch a lot of CNBC or Bloomberg TV, you probably see him on a fairly regular basis on there. So it is definitely a treat, and for us to be able to have him join us on Monday, November 22nd. So if you're not signed up for that, I encourage you to do that, and look forward to seeing you there. So with that, I'm going to actually turn this over now to Kenny, and he's going to actually take the things that I talked about and show you how we actually apply that when working with clients in more of a dynamic format. So, the last thing I would just say is planning should be thought of in the context of that it is a process. It is not a project. It doesn't have a beginning and an end to it. It is fluid, it's ongoing, it's dynamic, because as things change in the world, the plan needs to adapt for that. And so we're going to talk a little bit about that. So Kenny, I'll turn it over to you and let you take it from here.
Great. Well, thank you, Brad. So like Brad mentioned, what I have in front of us here is just a sample client, and I just want to walk you guys through some of the things that we're looking at as financial planners when we analyze a client's financial plan. So the first place to start is to just get an idea of what's out there today and what the current situation is. So the best way to do that for us is to build out a net worth statement. I think this is something that a lot of people breeze through without really taking time to digest all the information that you can glean from this. So right off the bat, we like to look and actually categorize the assets. So in this particular report, it's going to break down, what's in cash, what's out there maybe in qualified retirement accounts and on the Roth side. And we really like that. First, right off the bat, like Brad said, there's a lot of cash on the sidelines. So it's been spurring a lot of conversations around, hey, do I have an adequate amount in a emergency fund serving as a rainy day place to go, or potentially do I need to move that out? And unfortunately, with the interest rate environment right now, bank products are not terribly attractive. So it's conversations around that of, hey, maybe what's the best thing to do with some excess cash? Beyond that, another thing to pay attention to is asset ownership. You'll see that in the columns of this report. This is really important as you begin to talk about legacy and estate planning. How are your assets owned? Are they named by a trust? Potentially, based on some of the state laws, there could be issues if maybe one of the spouses owns the vast majority of the assets. Maybe concerns about evening that out a little bit. Going forward, another thing that we like to take a look at here is the taxability of the assets. So this particular client is pretty well rounded, where they have some taxable assets that'd be subject to capital gains. Here in the traditional retirement space, those would be ordinary income, and they do have a little bit of Roth bucket as well. This is probably not necessarily typical of what we would see. A lot of what we're seeing commonly now is maybe the vast majority of assets in a 401k plan, and clients not always realizing that when they go to withdraw that, that's all going to be subject to ordinary income tax. And beyond that, when they leave it as an inheritance, that'll be taxed to their heirs at ordinary income tax rates as well. Finally, one really important distinction that we make when making these net worth statements is the difference between what's liquid and accessible and what's illiquid. So I mentioned that we're seeing a lot of clients that just have large balances in their 401k. Another thing that we're seeing a lot of is clients that have really the vast majority of their wealth held up in something illiquid, whether it be a business that they put all their hard work into, or potentially on the real estate side, if there's maybe a couple rental properties or something like that. So I think, again, this net worth statement, I think it's something people breeze through really quickly. But as financial planners, we want to take this in a little bit. Again, we're thinking about what's the taxability of these parts if we want to move them around, potentially make some withdrawals or sales. How's everything owned? And then from a liquidity standpoint, what do we have to work with? So once we know what's out there, we'll move into a cash flow analysis. Let this load up here. So I'll give you guys just a minute to take this in, but I joke this is really just a glorified spreadsheet. So you can see we have the years and client ages running down the side of the page here. And we're just tracking here income flows and outflows for the household. So this is more that dynamic piece. Start with that net worth to figure out what's out there. Now we want to actually track, take a look at your household and think, okay, what are the inflows and outflows for you guys? So if I just jump into income flows here, this is just going to look at traditional sources of income. Scroll down just a little bit. So for this particular client, we can see, they intend to work and both earn a salary here up until this light blue bar signifying retirement. So what this does for us is allows us to see the timing of some of these significant events. So these folks are really fortunate where when they're done working, they have some income replacement immediately in the form of a pension and some Social Security. But frequently we'll see some trends jump off the page to us, kind of saying, hey, maybe there's a 5-year gap where there is no income at this point, and maybe there's some increased health insurance costs, and that's something that we're going to need to plan for. Additionally, this Social Security piece constantly on retirees' mind. For these folks, it seems like they're kind of lining that income replacement right up, but something that we want to look at here, see things added up on the right. What does the total amount of income look like? So then on the outflow side of things here, be these two columns. In general, two really basic things we could do with our income once we've earned it. We could either save it or spend it. So on the savings side, we're cued into where are these dollars being put? Are they maxing out a retirement plan through their employer? Outside of that, potentially, are they looking at an HSA, Roth IRA? Maybe they want to fund a taxable event or a 529. So the quality and type of places that they're saving is going to be important to us. And frankly, sometimes just kind of reminding clients what the increased limits are for where they can store money and creating some sort of prioritization to say, hey, maybe it's employer retirement plan first. And then if education is a top goal for you, let's talk about that 529 plan. On the expenses side, again, another handful of themes that we can glean from this. So you'll see a number of things kind of adding up here to get our total expense number. on the far left, this really represents their true lifestyle need. So this is really just day-to-day spending on an annual basis to meet their level of lifestyle. On top of that, we're tracking these liability payments just because we want to see when they expire. Similarly, on the insurance side, maybe there's some term policies that are running out. But this tax piece is really important. And really what this is going to do by looking at this analysis, hopefully, is identify some opportunities for us as financial planners that potentially there are some years that we can make some moves. So if you just look at, this number going down the page here, you see a little jump at the moment. We do expect some tax reform change, but this is when the current sunset would take place. So we want something that we want to anticipate there. And then the big jump would be at retirement. We see this pretty massive reduction in total income taxes paid, and coordinated with that is their tax bracket decreasing. And again, that's a planning opportunity for us. Potentially, they want to would consider maybe some Roth conversions in these years. And that's something that we're really going to pay attention to. And we start to build out some sort of withdrawal strategy for a client is, hey, what does your income tax bracket look like going forward?
Hey, Kenny, I'm going to jump in here, but we have a really good question about, is there a rule of thumb on how to prioritize the spend down of assets? Should I cash first, non-qualified accounts, qualified accounts? How should I prioritize that? I think our approach is there's really not, we might have a general rule of thumb, but when you're looking at this analysis right here, it should be really tailored to the client in determining what order makes the most sense. And certainly taxes play a big part of that analysis, correct?
Yeah, thank you, Brad. In just a minute, I'll jump to a withdrawal screen and we can dive into that a little bit deeper. So if we just look at this report from a really high level here, we have our inflows in this section, outflows summarized right here, and ultimately we get some sort of net result from this. So you can see while these folks are working, they more or less operate what we call kind of a net even household. So more or less a wash at the end of the year, but ultimately this day comes when we do retire and we're seeing this deficit here, which is acknowledging we're going to have to dip into our portfolio and make some withdrawals in order to cover our lifestyle. So this report here is kind of letting us know maybe what we can anticipate we might need in withdrawals. And then the other thing that I'll note here on this report is once they hit age 72, each of the clients here, they're subject to required minimum distributions. We're seeing that in this plan distributions column right here, kind of saying whether you want to take it or not, you're forced to push a little bit out of these traditional retirement accounts. So this final right column right here, this is tracking specifically the liquid portion of net worth. So this is truly their portfolio value. See, as they're working, they accumulate really nicely here. And then we kind of flip the switch from accumulation mode to withdrawal mode. You see this deficit here, meaning we got to dip into these assets and start to take a little bit out. You see that growth slow down. So if we want to take a little closer look at withdrawals, can go to this report here, which is going to give us just a little bit more clarity. So to break this down, kind of have all their assets across the top here. And this plan section is letting us know, what are these required distributions we have to take. So there's a little bit of an inherit account today. And then the big planning event is each of these clients reaching age 72. So to answer that question, this software, they have a default withdrawal strategy that's going to be really kind of straightforward based on taxability, saying, hey, if it's a small withdrawal and there's cash, go ahead and take it. Next priority would be dipping into a taxable investment account. And this is where really you do need an advisor to kind of step in and say, does that make sense? So we see these big withdrawal years here. This column is telling us the withdrawal need. And the default strategy would say, hey, just go to your taxable investment account, just take things at capital gains because it's the lowest. But what we saw when we're looking at those tax rates is saying, hey, that's probably not the smartest thing to do. We have this period of years here up until you turn age 72 where you're in a really low income tax bracket. And that's frankly an opportunity for us to start withdrawing some of these 401k IRA dollars at a lower tax bracket, because ultimately, if you're not paying the tax on that someday, your heirs will. And so we want to be strategic, saying, maybe it's a combination of both at that point. And like Brad said, this would be very specific to the client, making sure we meet their needs. But what I really like about this report here, again, this column is kind of letting us know right off the cash flow report, what is the withdrawal need? And then this column is what is the portfolio base. So we start to get a nice withdrawal percentage here. A lot of commentary in our industry right now about what a safe withdrawal percentage is. And I think 4% maybe is the kind of old rule of thumb there, but it's something we're paying attention to. You can see as these RMDs start here, clients are going to be forced to push a little bit more out. So we're tracking this over time, saying, your portfolio as a whole, based on your level of lifestyle, how much do we need to pull out on a yearly basis? A couple more reports I'll show you just really quickly. Let this load up here. This is a projection of what your asset values will be over time. So, we started with that net worth statement and say, hey, where's everything at today? But we know some of these assets are going to grow, whether it's a business or piece of real estate or an investment account. And the way our clients like to think about this a lot of times, I jump into this retirement assets one, they'll phrase it, say, hey, what's my number? I check my 401k account every couple months, and I'm saving really aggressively in it, and I just want to know, what do I have to get to in order for me to feel comfortable to retire? So we're able to kind of track that over time and say, hey, if you keep making good contributions, we get some decent market returns. If you can reach about this range in that account, assuming everything else is still going to plan, that would make us feel really comfortable. And then along with that, I know Brad touched on this, and this is really a whole separate conversation if we wanted it to be. But what does the quality of your portfolio look like? So I'll let this load up here. From a really high level, we can't just look at that number to say, okay, 401k is 2 million or whatever it might be. We actually want to see, within that, what's on the stock side, what's on the bond side, is there potentially any alternatives in there, international exposure, etc. So this is really the engine for the vast majority of clients that's going to fuel their retirement plan. So this could easily be its own call, but something that is truly important to the plan. The nice thing is that you see all the things that we look at before we visit this asset allocation number. You can't just say, hey, I have 2 million. What should my allocation be? You want to go through these proper planning steps. You want to have an understanding of what you might need in retirement, what that withdrawal pressure is, and what some of your goals are, really before you can have a really targeted investment approach. Okay. So those are some of the reports that we like to look at. As advisors, we want to see things proven with the numbers, and we're kind of anal that way. We like to track all the dollars, where all the assumptions are being made. But for our clients, the vast majority of them are really going to enjoy this screen, and this is the more dynamic visual side of things. So what we're looking at here is just a bar graph, their portfolio wealth over time. So you see this, got the years tracking along the bottom, the wealth here growing, but you notice this really steep slope, and this is their working years, the retirement dates down below. So they're accumulating really nicely, hit this retirement age, and more or less are able to sustain. So we put a lot of effort into building what we call the base case, which is just the best working guess for what might happen. But planning really is all about what sort of scenarios might happen. Maybe we want to play with our retirement age. Brad mentioned a lot of clients are kind of thinking, hey, there's been a lot of disruption in my industry. thinking maybe I'll call it quits a little bit earlier. So I can actually throw this on and get this great visual to show clients. Let this load up just a minute here, what the projected impact of doing that would be. Zoom out just a little bit. Beyond that, maybe we're able to prove to clients, hey, you're going to have enough money. It's not a concern whether or not you have enough. It's more so, what are we going to do with this? So they'll say, okay, I'm okay working to that age, but maybe there's a country club that I really want to join, and a couple big trips that we think we want to do for a number of years here. Is that feasible? Is that within the possibility for me? And we're able to show clients that. So once you kind of get a feel for maybe what some of their aspirations are and whether or not it's going to be possible for them, we want to do some stress testing to really show how resilient these plans are. So one way that we do that is through Monte Carlo analysis. I know this is becoming more and more popular in the industry. We're kind of seeing this done in a number of different ways, but essentially what this does is it just does 1,000 random trials based on previous volatility that we've seen in the markets, and looking at standard deviation of returns. So, it's not adequate planning just to pull up an Excel sheet and say, hey, I might average 5 or 6% rate of return and just assume that that's going to be straight line throughout the whole life of the plan. Brad showed that graph. We know returns. There's bad years. Sometimes there's even tough decades. But as a whole, we tend to get some nice returns. We just don't know what sort of pattern we're going to take to get there. So what this is doing is kind of just trying to take a guess, based on previous volatility we've seen in the market, what sort of range these assets might be in. So we kind of get on the high side of things at this line, pick the median here, which is that graph we were looking at earlier, and then what if we get some really below average market returns, and ultimately give us some sort of probability of success. We are running this plan all the way out to age 100, so we're really planning for some potential longevity, but something that's important to do. You can't just use the old method of saying, hey, I'll get 6%, consistently throughout the next 20 years or something like that. Additionally,
Eddie, can you, I'll let you finish this, and we've got a number of questions coming in, so I'll let you finish this piece, and then we'll go to a couple questions.
Great, thank you, Brad. So this piece is a really similar type of information, just in a different format. So we're actually looking at the probability of success as the ages go on. So you can see the calendar year and the ages, giving us a likelihood based on real general statistics that at least one of the clients would still be alive at this point, and what the probability is that they would still have some assets remaining. So you can see, with the increased expenses here, be able to tell a client, hey, it's looking like you probably pull that off. Maybe we get a little nervous about the projections of things once you get into your 90s. But ultimately, it's going to give us what they call a confidence age, saying, based on everything we've looked at, running 1,000 random trials, the vast majority of time here, we can get you to your early 90s and still be pretty confident about our planning. Brad, go ahead with those questions.
Yeah, so maybe if you go back to the original graph and shut the buttons off. So the questions, I'm going to summarize and try to package them into one here. But our overall return assumptions, what's our standard return assumptions, inflation assumptions as well. And then maybe in the midst of that, you may want to show how we can project future values and show present value as well. So maybe the whole dynamic around return and inflation and how we address that.
Yep, thank you, Brad. So on the inflation side, we use the 30-year historical average CPI, Consumer Price Index. So that's something that we update quarterly. So, I know the inflationary environment is high today and potentially will be for, another year or two in the future. But if you look at this forecast, we're doing about 45 years of retirement planning here. So we do like to use that 30-year average, saying, you know, some years it's been really high, some years it's been pretty low. So that's the best guess that we can use, 30-year historical CPI. On the investment return side of things, we are also tracking historical returns of the market. So we use, let's say we pick about a 60-40 portfolio, maybe 60% stocks, 40% bonds, and we're tracking the underlying indexes of everything that would go into, you know, a potentially a typical 60-40. And we're saying, you know, that's potentially what they'll be invested in. Typically for us, that ends up being, you know, we lean really conservative, we'd like to think. So about 6 and change while they're working. And then at the retirement age, we drop that down to about 5. And that's because for the vast majority of clients, once they do stop earning that income, they'll take a little bit of risk off the table, just knowing that they're in withdrawal mode and they want to be a little bit more cautious. So something we can address on a client by client basis, but that's typically what we're using.
Yeah, and I'll just add, Kenny, and I know we're getting low on time, but this part of the analysis is to really stress test various rates of return when we're forecasting. The key is the real rate of return, the difference between our gross return and what we're modeling for inflation. That's really the critical component when we're looking at these modeling forecasts.
Yep. So Brad, if I just have a minute or two here, you know, once we create this plan, we feel really good about it. There are some, you know, additional ways we can stress test it. And this is more so looking at the insurance side of things, kind of saying, hey, here's our plan, you know, here's all these assets we've accumulated and we're bought into it. Now we're thinking about protecting it and how can we do that? So here's a survivor scenario looking at the effectiveness of life insurance if something were to happen to one of the spouses. So you see a little bit of green here where that death benefit would kick in, but ultimately behind the scenes, you know, you're seeing a lost salary, a lost Social Security check coming in the door, but we're actually able to prove to clients, you know, what is the insurance number that you need? Are you overinsured? Are you underinsured? Or do you want to self-insure? And just the big thing is making sure you're aware of the risk and that you're game planning, you know, for you know, some sort of unwanted outcome, that you're at least ready for it. And then the last thing I'll show here, and this is kind of the final conversation that we'll have. And I'm just going to go out maybe to calendar year 2040. So once we kind of establish, hey, this is your plan, this is how we're going to get you guys through your life here. The last part of this is kind of saying what will your legacy look like? We want to do some estate planning. So you kind of see, you know, each spouse's net worth here, and then ultimately, what does this look like when it gets passed on? So the first thing to cue into is what are the costs to leave your assets behind to your heirs. So they don't quite reach a point here where they'd be subject to estate tax, but we know there's a lot of talk in Washington about this law being changed. So something we're having more and more conversations on. This last piece here we think is really important, often overlooked, is when you pass these assets on, they're going to have some tax consequence to your heirs. It might not be an estate tax, but again, those retirement assets, they're going to be taxed at your heirs' income tax rates. It's called income with respect to decedent, and something that we want to be calculating. And then the final part of this here is looking at what will your inheritance look like? What are those pieces? So these folks, you know, pretty straightforward, just 2 children they want to give all their assets to. So we're saying, you know, potentially 20 years from now, your children will inherit some portfolio assets, and you'll see the different accounts that could look like. They're also going to inherit some real estate assets, 2 different pieces here, and so forth. So it's a lot of planning we can do there. Maybe just the last thing I'll throw on here is to say, you know, this is looking at everything held within the estate. Some advanced planning would be to say, you know, maybe we want to hold a life insurance policy outside of our estate. Maybe we want to do some gifting to charity or to family. So if I throw this toggle on here saying, during our lifetime, we want to do some active gifting to our family, we see this new column here saying, you know, 20 years from now, what's the total amount that we've been able to push outside of our taxable estate during our lifetime? Brad, I think that's probably about all I had to show. I don't know if any new questions have come in or if you want to touch base on anything else.
If you could go back to the first graph that you showed. I want to get to the inflation question and maybe just show that in present value.
Yep, thank you.
And just explain that.
Yep. So I'm just going to pick a year for us here. Let's just use the calendar year 2050. Both these clients are in their mid 80s. It's kind of saying, hey, portfolio value might be about 6.8 million. Well, what would that really feel like in today's mindset? And we can actually discount that back. So kind of saying, you know, what would 50 million, what would that 6 million feel like in calendar year 2050? And so to actually put that in today's purchasing power and account for inflation, that might be about 3 million of today's dollars.
All right, thank you, Kenny. And then Social Security, the timing of that. I know you've got some modeling here showing that, but we do, you know, a lot of our clients think in terms of how can I leverage Social Security as an asset and try to maximize the return on it. You want to share some thoughts around that and how we provide analysis there?
Yep. So there's a lot of Social Security analyzer tools out there that can give you a great start about, you know, thinking about when to draw Social Security. But I think maybe the pitfall of those is they only isolate the Social Security drawing decision and not the greater financial plan as a whole, thinking, hey, maybe there's a lot of portfolio assets that are out there as well. So we tackle the Social Security drawing decision. We're looking at the whole picture, and it's kind of a teeter-totter for clients. So it's either your own savings that you're going to have to use to cover some expenses or Social Security. And Social Security, every year that you wait to draw, you're locking in an 8% raise that's with you for your lifetime. So for every client, it's vastly different what we end up recommending. So you think, you know, I want that 8% raise, I want that for my lifetime, but every year that you wait to do that, your portfolio value is taking a hit. I think one decision that clients don't think about very often is that savings that you have, that's your own money that you worked hard to accumulate, and you get some direction of where that goes when you pass. It's kind of, you know, that's your sweat that created that. That's your bucket to live off of, and ultimately you could decide what happens. Social Security is just gone. You know, you can use it while you can, but then at your passing, it's done for. But I'll just throw this toggle on there to kind of say, hey, instead of drawing right at retirement, what if one of the spouses waited till age 70 here? And so this is kind of looking at a decision to delay. So if you look really closely, you can see a little bit of a reduced amount here, but eventually there is this break-even point, kind of showing when that increased benefit would make things advantageous to the client. So there's really no cut and dry answer for this one, Brad. Kind of saying it's you know, on a per client basis, there's always end up being some break-even year where if you draw early, you know, your portfolio loves that there's not as much pressure on it, but that reduced benefit will catch up to you. So, you know, it's not really a joke, but we always kind of tell clients, hey, if you knew exactly how long you're going to live, we could tell you exactly when to draw Social Security. But other than that, you just have to, you know, play the game and draw when you think is the best.
All right, thanks, Kenny. The last question is more around wealth transfer. And so the question had to do around current exemption, and then when is the exemption based on today's code going to be reduced? Do you have thoughts on that?
Yeah, so the current sunset would be in 2026, and that's kind of reverting back to, I'll call it Obama era state tax exemption. So Brad, correct me if I'm wrong here, but somewhere around 5 or 6 million per spouse on a federal level at that point.
Yep. And today it's north of 11 per person.
Yeah, and then you know, your guess is as good as mine as what will ultimately happen in Washington, but it sounds like the inkling is to kind of just bring that sunset up a little bit earlier, where we might see that revert back to, you know, that 5 or 6 million per spouse number, you know, potentially next year or something, but who knows what they'll decide in Washington.
Yeah, and just a comment around that, what you're looking at as far as the software, it really works well for clients who are below the exemption to do a variety of views and analysis, but it works extremely well with clients that do have estate tax issues as well. And there's a whole nother call we could have, Kenny, on that to really talk through the analysis that's involved in that. The other piece that I'll just say with regard to wealth transfer is knowing what's going on at the federal level. There are some states that don't follow the federal code and have their own state code. And so understanding too, are there transfer costs at the state level as well? And so, like I said, we could probably do a whole call on a number of these topics and questions that we've had today. So running pretty low on time here. So I think we'll wrap up, and we really appreciate you taking the time to join us today. If you do have questions, feel free to reach out to us. We'd be happy to have one-on-one conversation with you and provide any assistance that we can. So thank you again for attending, and we look forward to seeing you again at one of our future presentations.